Well, it'd be nice, wouldn't it, to not have to worry about getting together a deposit for a bank, for a loan from the bank to buy something to live in. Just a house, just maybe a flat, maybe just something, well, pretty humble, pretty straightforward. It's not easy, and many people get knocked back by the banks. But it's not so hard to get knocked back by your folks. Some incredible new figures have been released by a company that's been looking into it. They're called Direct Finance Analytics, and Martin North is with us now. Good morning, Martin.
Good morning. It's Digital Finance Analytics, actually, but no problem.
We've got another phone line on you there. I'm not sure why that is. Just stand by for a sec. Oh, I see. You're on Skype. You're not on the phone.
Correct.
The
High tech.
wonders of technology. Well, that took me a couple of seconds to figure out. Now, you've looked into this, and really what you've found is that this bank of mum and dad's doing quite well.
Yes, it's pretty interesting. So if you go back a few years, the Bank of Mum and Dad hardly existed in Australia because most people were able to save for that deposit in their own right. But over the last few years, as home prices have risen, as incomes have remained relatively flat, it's become harder and harder to put that deposit together. And so because overall home prices have been rising quite strongly, a lot of people have equity in their existing properties, and so therefore now the Bank of Mum and Dad comes into existence. You pull money out of your own property and you pass it down to your kids, allows them to get into the market, and of course take advantage of all those first owner grants which are now around. So that's what's been happening. And looking at the research, it's been growing quite fast, 25% over the last sort of year or so, and the average amount paid, and this is an amazing number, is $89,000.
That's a big chunk. So what is it? You're really saying that a lot of parents are pulling this out of the equity they own in their own home, so refinancing or maybe remortgaging after they've owned it for some time to get access to this cash.
That's exactly right. So about 60% of the Bank of Mum and Dad people who are actually passing the money down the generations get it directly from the equity in their existing property. Now, others may have it in savings or in other resources, but it's predominantly from the equity growth in their own property. And of course, if you think about that, that's great in a rising market because you'd assume that home prices will continue to rise, and therefore, when you come to retirement later, you probably won't notice the difference. But of course, if prices slide, and some people are suggesting they will slide now, this could be an interesting challenge because then the question is, you've handed that money down the generation, but have you still got enough for yourself into retirement?
I think you've described this as an adverse impact of an intergenerational financial embrace. Which I love. It's a kind of death hug as you go over a cliff, I suppose.
Well, you can understand why people want to help, right? Because, in the past 30 or 40 years, it's been the home that has been the massive wealth creator in Australia. And so if you've got kids and you want to help them to get into the market, you can absolutely understand, if you're able to help them get in while you'd want to. But it's not without risk. Certainly from that sort of intergenerational perspective. Firstly, if you're older, are you giving away the stuff that you'll need in retirement? But if you're younger and you get that help, what's interesting is that our modelling also suggests that you are twice as likely subsequently to default on your mortgage because you haven't had the experience of having to slave and save for a long period of time to get that deposit together.
That's interesting.
So there's a bit of risk on both sides of the fence here, as well, of course, the question as to how well structured and documented is it. So what happens, for example, if your kid then goes and remarries or defaults and doesn't pay you anything? There's a bunch of issues here in the background which I think are probably worth thinking about.
Are. And I'd be keen to hear from you if you've had this experience and if you've got a piece of advice for people who might be entering into this kind of arrangement. 1300 222 702 is the number, 1300 222 702. What's fascinating also about this, Martin, is that the number of first home buyers that are getting assistance from their parents, 55%.
Yes, it's over half now, and go back a few years, it was almost nobody. So this is really a very strong trend. And in fact, if you look in Sydney in particular, where home prices have been very, very strong, it's even higher than 55%. So the majority of people who are getting into the market now are doing it on the back of the bank of mum and dad, which of course raises another interesting question. What happens if you are not fortunate enough to have wealthy parents who can help you? So it begins to create a divide between the haves and the have-nots, and it's a divide not in just one generation, but across the generations as well.
Well, this is something that came up a couple of years ago. The Prime Minister, Malcolm Turnbull, was talking to our sister program down in Melbourne, John Fane's program, and this came up. It was quite a memorable moment.
What, are your kids locked out of the housing market, John?
Yes.
Well, you should shell out for them. You should support them, wealthy man like you.
That's what they say.
Yeah, exactly. Well, there you go. You see, you've got the solution in your own hands.
That's hardly national policy.
You can provide a bit of intergenerational equity in the Fane family.
I think he regretted those words, Martin, not very quickly, not very long after uttering them. But, it does seem like it is happening and maybe, that's how it is now. But it does also have a flow-on effect to the market itself.
Well, it does. Two perspectives. The first is it helps to lift house prices even higher, of course, because it means that people have more ability to buy into the market if they've got that cash from their parents. But the other side of the coin is this: many of the banks perhaps don't have sufficiently strong underwriting standards and processes inside their systems to be able to detect the difference as to whether the deposit came from savings or whether it came by way of a Seagull gift. And like I said, there are some different risk scenarios in those two different situations. So there are potentially not only higher home prices, but higher risks in the system as a result of this.
We're going to talk to somebody who's seen these up close in a moment, Dr. John de Groot. He's Special Counsel at de Groot's Wills and Estates Lawyers, a specialist in this area. But let's hear from you, Alison in Penrith. Good morning.
Morning.
Now, you recently bought a house.
Yes, we did.
And you received some help?
Yeah, we did. So we purchased in the last 18 months. My husband and I had 2 children already, and we had done as much savings as we physically could, given that we both worked full-time, but then also had daycare costs on top of that because we did work full-time. And both my in-laws and my parents very generously gifted us some money to go towards a deposit. But they were both very clear, which was very generous, but they didn't gift us any more than we had already saved. So they were quite willing to help us, but we're insistent that we had saved some as well.
So did you have some really hard conversations around the kitchen table, like what if you break up or what ifs?
Look, we didn't. We didn't actually, but I will be honest, the bank insisted that when we got our loan, we did have to have the paperwork to ensure that it was a gift, not a loan. So we did have to have that all signed when we got the
okay. All right.
From the bank. And we also made sure that because we were aware we were borrowing, we kind of ran it through both our sets of parents when we were buying to make sure that we weren't overextending ourselves. So we used their advice and their knowledge to help us out as well.
Yeah. Oh, that's good. Sounds like you kind of got the best of both worlds there. You got a bit of advice as well as some money. Thanks so much for that, Alison. Let's hear from Karen in Manly. Good morning, Karen.
Hello.
Yeah. What did you do?
We did a combination of going on the title, but also drawing up a loan agreement for the bulk of it and having a lawyer do that. Mm-hmm. And we wanted to do that for protection in the event that we don't know what the future holds, and we just wanted to have some certainty that no matter what happened, we'd be able to get the money repaid at some point.
So you and your husband and your son are all on the title?
Yes.
Uh-huh. And on all the legal documentation relating to the loan?
Yes.
Oh, okay. Yeah, okay. I can see why that makes sense. And you feel comfortable about that?
Yeah, absolutely.
Yeah.
So, I mean, we thought about things like down the track he could have a living girlfriend and then he could be in an accident and something could happen to him and, you know, there could be unforeseen things happening.
Yeah.
So we just wanted some protection and...
sometimes
that was a bit strange at first, but then I think he realised it was sensible.
Yeah. Yeah, sometimes it's really quite hard to forecast what's going to happen in your life. A couple more calls, but I want to hear from to John. John de Groot is with us. He's special counsel at de Groot Wills and Estates. John, good morning.
Good morning.
You're probably listening to this and in the back of your mind going, what do you see as one of the most common problems arising from these arrangements?
Well, I think the biggest issue is making sure that when these loans are made, that they're properly documented, or if there's a gift, that it's properly documented. The biggest problem from a legal perspective is the uncertainty about really what happened here, especially down the track. There can be understandings, but people's memories fade, attitudes change, circumstances like people separate and divorce, and then what happens, this gift into the family from one side can flow fairly significantly to the other side. So that's an unhappy situation as well. So really, at the end of the day, it's all about properly documenting things. And if, in my opinion, if there's a loan and it's properly documented, it doesn't become statute barred if it is not refreshed after 6 years. But there's a lot of legal issues that people really ought to just spend some time and attention on.
Yeah, I imagine, and I want to hear how they go about that in a moment. But let's hear from Warren in Bankstown. $500,000, Warren.
Roughly around that figure.
Yeah?
Yeah. Look, I've got good... It's mainly my wife's super. But, hello?
Yeah, we can hear you.
It's mainly my wife's super. Like, I've got good super, and I've been lucky with some real estate investments, so we were able to do that. But the secret is, the last person was right. You must have your name on the mortgage, okay? And we set up a trust that protects the interests of our other kids if anything happens to us in terms of, if they get married or a marriage breaks down, that other party can't access our component of that property.
Right.
It goes to the state, and it protects the other kids' equity.
Okay.
And the kids who have the houses have the option to buy it out of the estate if anything happens to us prior to it going.
Warren, what about if you and your wife break up? You've got her super now.
Well, yeah, that's... I suppose she just takes it out of my share of our house, doesn't she?
There's a few complexities here, aren't there? Yeah.
That's a great area I never thought of.
Yeah, well, there you go.
But
I
assume, I assume, I suppose she takes the equity of our property, you know what I mean, that we live in.
Yeah, well, let's find out. Let's find out what John says. John, that's another aspect.
Yes, look, I think between husband and wife making loans, any adjustments would be made if there was a property dispute, and the family court had to decide. That's obviously a relevant consideration, and the court would make adjustments to see that a proper outcome was achieved. But of course, nobody wants to be arguing about these things, so again, it's better to have a clear understanding of what would happen in those circumstances and who would get what. I mean, you know that we can, these days in Australia, do prenups or nuptial agreements, they call them financial agreements, where you can determine for yourself how things will be divided up in the event that the marriage came to an end or the de facto relationship terminated.
So just to be clear, when you make an agreement like this, you can do it privately, go to a lawyer and do it, but do you also have to involve the bank in what you're doing?
Well, I guess it depends on what's occurred. I mean, I guess the people who are applying for the loan, if they've asked specifically, well, where have these funds come from, then truthfulness is required, undoubtedly. But it really just depends on the lender, what they require by way of information and documentation. I know one of your earlier callers said that the bank insisted on citing the deed of gift, presumably, that confirmed that what they'd received from their parents was actually a gift.
Okay, so that small but important word has to be there. Yeah.
Yes.
Yeah. Okay. All right. Let's go back to Martin North, who's an analyst with Digital Finance Analytics, who's done a bit of this, looking into this area. Martin, how much money are we talking about, and what do you think? This is a growth industry. How much is in this bank of mum and dad?
Well, it's 20 billion at the moment and growing. And I think we said earlier on, it's the 10th largest lender in Australia at the moment. So after the big four and the regional banks, the Bank of Mum and Dad really, is there, and it's still growing. And I expect it will continue. And there's another reason, of course, that the banks are tightening their underwriting standards, which means that you need a bigger deposit than previously, right? So that means that you've got to actually find a way of putting more into the property. And therefore, I think we're going to see the Bank of Mum and Dad continuing to grow.
Yeah, bigger, as you say, than ME Bank, AMP Bank, the local operations of Citigroup and HSBC. That's incredible. Amazing figures. Let's just finally hear from Tully. Tully, you're an aged care specialist. What do you see?
Well, I think the biggest issue is that mum and dad and actually grandma and grandma are getting older. And we know very clearly that people over 80 have an increasing incidence of dementia, if not dementia, cognitive impairment. And they're the ones that are entering into these agreements and contracts. And I see it every day now, more and more. The lawyers are having a field day because it's later on where everyone's arguing over who actually owns the house.
I see. So it's kind of a very vulnerable time for people. And even if you do get this advice, you may not understand the full consequences of it.
Absolutely. And there's the issue of older, frail parents who are dependent on their younger ones. They love them and they do all these, they give gifts. Or they just get into contracts or mortgages. And I must say, in my own practice, half of my time is now about whether old people have capacity to undertake these sort of complex financial transactions.
Wow.
And it's a demographic that's really just going to become bigger.
Yeah.
And it's enormous.
Yeah.
People are not talking about it enough.
Wow, that's really interesting. Maybe we'll have to talk to you again sometime and get some more details about that. It does sound like a growing issue. Thanks so much for talking with us, Tully. Just stay on the line there. Just stay on the line. And thanks also to Martin North from Digital Finance Analytics for talking to us. Thanks, Martin. That was fascinating.
Good to talk to you.
And also to John de Groot, Special Counsel at de Groot's Wills and Estates. Fascinating, and I'm sure this is going to keep you in business for some time, John.
Well, it's all about looking after clients' best interests, and what I've been talking about is seeking to do that so that there's clarity and a clear legal framework, which is so important for people's affairs.
Okay. All right. Thank you once again. And thanks to everyone who called in and a lot of people texting as well and giving some advice. I might get to that in a moment. But
Cassie McCullough with Focus
on ABC Radio Sydney.